Eric Robertsen, who is a global head of research at Standard Chartered Bank, joining us live from Sydney. Eric, it's great to see you. Thank you very much for your time. Hope you're safe and well. Give us your own sense on what the Fed may say later this week.
Well, I think, as you just pointed out, there's relatively little expectation for any material policy change in terms of rates and bond buying as well. However, I think what the market's very focused on is whether there will be any changes to the Fed's forecast. There is clearly an expectation or an assumption that they'd have to raise their growth and economic activity outlook and perhaps lower their unemployment rate forecast. The big question, though, is what will the dots be adjusted to, if anything, to reflect rate hikes? Our assumption is that looking out into 2023 and 2024, you will see more Fed governors talking about rate hikes. And so the dots on an average term may start to tweak up a little bit, but we're not expecting anything for 2022. And as you say, we are expecting Powell to reiterate a fairly consistent pace of bond buying.
Sure, but what will that do for the markets? Because the rise has been fairly significant in the 10-year benchmark. Does the pace of rise continue or abate, depending on what the Fed says?
Yeah, sure. I mean, look, I would argue that 10-year yields would consolidate here for a bit. I mean, if you look at current market pricing, Tanvir, we've got nearly a full rate hike priced for the end of 2022. And we have a total of roughly 3 hikes priced out to the end of 2023. And so the market is pricing in a bit of an adjustment in the dots and in the Fed's outlook. If they were to validate that, I'm not sure the 10-year part of the curve would react too much to that. But we do know that U.S. rates markets have a tendency historically to price in the full rate hiking cycle before it even starts. And some of the longer dated forwards are starting to reflect that already.
Quite significant in terms of the market pricing in those moves ahead of time. Eric, I do want to understand, if you're talking about a big reflation trade in the U.S., how does that link back to Asia? What does that mean for Asia, where, of course, you have the Asian exporters that are exposed to the Western economies, but also you have the domestic growth story, which is being fueled by, local government policies?
Yeah, sure. I mean, look, one of the things that has really changed quite dramatically over the course of the last month or 6 weeks is the diversity of growth around the world. Now, as we came into the year, we were expecting a fairly meaningful recovery in global economic growth, but led largely by Asia. And we had some concerns about other regions, Europe, for example. And we weren't sure what would happen with the U.S. just because of the uncertainty around fiscal stimulus. Now, we've gotten the full $1.9 trillion of fiscal stimulus already in the first quarter of the year, and people are already starting to talk about the possibility of infrastructure spending. So the good news is, as you say, the U.S. growth outlook looks extremely robust, and that should be very good for not only the domestic economic story, but also the exporters from Asia. And trade for a large part of emerging markets, but especially Asia, has been a big part of the growth recovery, or the reflation trade, as you describe it correctly.
But as I break it down, it seems to me that it's a double plus for Asian economies. And so for them to outperform the West, perhaps because of export-led growth, domestic growth picking up coming out of this pandemic, the outlook would be stronger going into 2021 for Asia versus the US or Europe.
Well, look, I think the growth differential will remain in Asia's favor. But if you look at equity markets as an example, in the first, shall we say, 6 weeks of the year, you had emerging market equities meaningfully outperforming developed market, including the S&P. More recently, that performance gap has almost completely closed. So we have the S&P up 4.5% or so for the year. MSCI, EM, and DM all up in the sort of 4 to 5% range. And I don't think that's because Asia has been downgraded in terms of its outlook. But what I think has happened is obviously people have been forced to upgrade the U.S. economic outlook to a level that's more consistent with the rest of the world. Now, as you point out, I would argue that that's still a very good story for the trade-dependent economies of Asia and those economies that are most open. But perhaps the performance gap has narrowed just a touch.
Okay, and finally, Eric, China, because we had data come out, data trio essentially, the activity indicators for the first 2 months, an anomaly, abnormal numbers, obviously base effect was pretty much an explanation. But once you skim that out or skim that off, what happens next in terms of the underlying economic trend in China?
Yeah, sure. Look, we have a very strong outlook for China's economic activity momentum for this year. We're expecting 8% growth for China for the year. Policymakers have more recently expressed a renewed commitment to having a bit of a floor in growth around 6%. So I don't think there's any risk of a material tightening of monetary or fiscal policy. They have talked about normalizing the budget deficit, which is to say be a little bit less aggressive with their fiscal spending. But I think it's very clear in our minds that between domestic demand and the demand for China's exports, that their growth model looks extremely robust for the balance of 2021. The key for China, and dare I say for the rest of Asia and for the US, will be how much is inflation contained in a world of rising growth.
Very interesting. Thank you very much for joining us, Eric, with your thoughts
Thanks,
on global macros.